The stock market has always been a simple game played on a complex stage. It doesn't matter what century it is or how advanced the technology becomes, the forces that move prices have never changed. Supply and demand, nothing more, nothing less. Every tick on the chart is a reflection of that eternal law. It's not magic, it's not mystery, it's just human nature expressed in numbers. When I began studying markets, I didn't have the luxury of screens or indicators. All I had was the tape, a stream of prices and volumes printing across a ticker. But that tape was alive. It told me where the pressure was building, where demand was gaining strength, where supply was overwhelming buyers. I learned to read it the way a doctor reads a pulse. Every surge, every hesitation, every reaction revealed the hidden emotions of the crowd. That's all the market is: human behavior under financial stress. The first truth about trading supply and demand is this: price is the effect, not the cause. The cause is always an imbalance between the two. When demand exceeds supply, prices rise. When supply exceeds demand, prices fall. It's that simple. But simplicity is deceptive, because behind those moves lies the entire psychology of the market: fear, greed, hope, and regret, all fighting for dominance. Most traders make the mistake of reacting to price instead of understanding what caused it to move. They buy after a long rally because they see prices going up and feel they're missing out. But by the time they buy, demand has already been absorbed by earlier participants. Smart money, the professionals, are quietly distributing selling into the strength created by the crowd's excitement. Then, when supply finally overpowers demand, the decline begins, and those late buyers are trapped. That's the law of supply and demand in motion, old as time, and it still fools men every single day. To trade profitably, you must learn to recognize where demand is likely to appear and where supply is likely to enter. The best traders don't chase price, they position themselves where imbalance is most probable. When you see a market that has been falling steadily and begins to slow down, where each new low fails to reach as far as the previous one you're witnessing, demand quietly stepping in. Buyers are absorbing all that selling pressure. The smart operator senses it, watches for confirmation, and only acts when the evidence is clear. On the other hand, when a market has been climbing for weeks and suddenly begins to stall where each new high is weaker than the last, that's supply beginning to dominate. The crowd may still be euphoric, but the wise trader sees distribution taking place. He doesn't fight it, he prepares. I remember one particular bull run that fooled nearly everyone. Stocks were soaring day after day, and it seemed nothing could stop them. The newspapers screamed optimism, and men were calling their brokers like mad. But the tape told a different story. Volume was heavy at the top, yet prices were no longer pushing higher. That was supply in disguise. Big interests were unloading while the public was still buying. I stayed patient, waiting for confirmation. When the market finally broke support, I acted swiftly. Within weeks, prices collapsed, and what had looked like endless strength turned into panic. That experience reinforced a lesson I never forgot. The market always whispers before it screams. Supply and demand leave footprints long before the big move happens. If you learn to see them, you'll always be ahead of the crowd. Trading supply and demand isn't about predicting the future, it's about reading the present correctly. Every rally and every decline contains information. After a strong decline, you'll often see a point where sellers become exhausted. Price stops falling, volume spikes, and candles start closing near their highs. That's a sign that demand has entered. But confirmation comes only when the market breaks above a previous reaction high, showing that buyers are truly in control. The professional waits for that moment. The amateur jumps in too early, hoping to catch the exact bottom, and often pays the price. The same rule applies at the top. When supply takes over, you'll see hesitation, failed breakouts, and heavy volume without follow-through. Smart operators distribute into that strength. The impatient trader sees the breakout and buys it, only to be caught when the price reverses sharply. The market punishes greed every time. The foundation of any supply and demand strategy is patience. Most traders can identify levels of interest. Few have the discipline to wait for confirmation. It's the waiting that makes the difference between success and failure. The crowd wants action. They can't stand watching the market without participating. But trading isn't about activity, it's about waiting for certainty. There's a time to trade and a time to observe. The professional knows the difference. Risk management is what keeps a trader alive long enough to benefit from these setups. You can have the best analysis in the world, but without control, it's worthless. No one is always right. That's why you must define your risk before entering any position. If demand fails to hold and price falls below your level, you must exit immediately, without hesitation. Hoping is not a strategy. The market doesn't care about your hopes. It only responds to supply and demand. When I was young, I made the mistake of averaging down a dangerous habit. I would buy a stock, it would fall, and I'd buy more, telling myself it was cheaper now. But cheap is a relative term. A stock can always go lower, and when supply overwhelms demand, there's no bottom in sight. Averaging down is another way of saying you refuse to admit you were wrong. That pride has destroyed more traders than bad luck ever could. The wise trader accepts small losses as part of the business. Think of them as rent paid to stay in the game. The amateur clings to hope and ends up paying a much higher price. In supply and demand trading, confirmation is everything. You never assume that a zone will hold. You wait for the market to prove it. For example, when price returns to a demand zone, an area where strong buying occurred before you don't buy blindly, you watch how price reacts. Is volume rising as price stabilizes? Are there long wicks showing rejection of lower prices? Is the overall structure showing signs of strength? Only when the evidence aligns do you take the trade. This approach requires emotional control, because you'll often watch perfect setups play out without you. The impatient trader can't stand missing out. He'll jump in early and pay the price. The disciplined trader misses many trades, but he avoids the bad ones too, and that's why he survives. Another truth that never changes is that supply and demand zones are not fixed walls, they're zones of balance and struggle. The market is dynamic. A level that held once might break the next time. Always adapt to the present conditions. The best traders are flexible, not stubborn. They trade what they see, not what they think should happen. Human psychology is the real battlefield in trading. The market simply reflects it. During a strong rally, greed blinds people. They believe prices will rise forever. During a decline, fear takes over, and they can't imagine recovery. But the professionals understand that both emotions are opportunities. When the crowd is greedy, supply is usually near. When the crowd is fearful, demand is quietly building. The operator who learns to act contrary to the masses calmly and rationally will always have the advantage. Every great move begins quietly. Before prices explode upward, there's accumulation smart money absorbing supply from weak hands. Before a crash, there's distribution smart money selling into public enthusiasm. If you can identify those stages, you'll see the truth long before the headlines do. I used to spend hours just watching a single stock, noting every little reaction, every pause, every surge. The market reveals itself to those who study it closely. It's like watching the ocean. You start to sense the rhythm of the waves. After a while, you don't predict the next move. You feel it coming. That's what experience gives you. But experience is built on mistakes. I learned more from my losses than from my wins. I remember a trade where I anticipated a major move upward. The demand zone looked perfect. The setup was clean. I entered with confidence, but the market sliced right through my level and kept falling. Instead of accepting the loss, I added more. I couldn't believe I was wrong. By the time I realized my error, the damage was severe. That one mistake taught me a lifetime lesson. Never argue with supply and demand. When the market tells you you're wrong, listen immediately. To succeed with a supply and demand strategy, you must develop 3 essential qualities: patience, discipline, and humility. Patience to wait for the right setup. Discipline to follow your rules without hesitation. Humility to accept when you're wrong. Most traders fail because they violate one of these principles. They trade too soon, they break their own rules, or they refuse to admit defeat. The market punishes all 3 sins equally. There's also the question of scaling. Many traders enter with their full position at once. I've always believed in scaling in and scaling out. Let the market prove your decision before you commit fully. Add to your position only when you're already in profit and the move confirms your thesis. That way, you're compounding success, not averaging failure. The same principle applies when exiting. Don't try to pick the exact top or bottom. Take profits in stages as the market moves in your favor. Remember, no one ever went broke taking profits, but many have gone broke waiting for just a little more. One of the most overlooked aspects of supply and demand trading is understanding context. A demand zone in a strong downtrend is weaker than a demand zone in a sideways or bullish market. The overall market sentiment matters. Trade with the larger tide whenever possible. Swimming against the current exhausts even the best swimmers. I've seen traders obsess over perfect entries, yet they ignore the larger structure. They want to buy every dip and sell every rally. But the true professional focuses on the dominant imbalance. If the overall market is showing consistent demand, you buy dips into strong zones. If it's showing supply, you sell rallies into weak ones. Align yourself with the path of least resistance. The market rewards those who think independently but act with discipline. You don't need to predict every move. You only need to identify areas where the odds are clearly in your favor, control your risk, and let probability do the rest. Success in trading is not about being right, it's about managing yourself when you're wrong. The greatest traders I've known, and those whose methods still endure, all share one thing in common. They understood that supply and demand govern everything. Every price move, every rally, every crash, every consolidation, it all comes back to those two forces and how they interact with human emotion. The same patterns that appeared on the ticker in my day still appear on charts today. The tools may look different, but the principles are identical. Buyers and sellers still dance to the same tune. Fear and greed still write the melody. And those who learn to hear it clearly will always find profit in the music. So remember this. You don't trade prices, you trade human behavior reflected in prices. You don't need to know what will happen next. You only need to recognize when supply is dominant or when demand is taking control. Trade with that knowledge, protect your capital fiercely, and stay patient. The market is not your enemy. It's your teacher. Every move, every reversal, every loss, and every profit is a lesson in disguise. Those who listen, who study, and who learn to respect the law of supply and demand will always stand apart from the crowd. Because in the end, that's what separates the professionals from the public. The crowd reacts, the professional observes, the crowd hopes, the professional waits, the crowd trades emotion. The professional trades imbalance, and when the imbalance appears when demand overwhelms supply or supply crushes demand, the professional acts swiftly, decisively, and without hesitation. Everything else is noise.